second part of the stock valuation. Up to now, we have discussed the discounted dividend model. You remember that this model is based on the assumption that analysts can forecast the future dividends, right? However, dividends are depend on the earnings, so the dividend forecast should be based on the future sales, costs, and capital requirements, right? And this recognition lead us to an alternative stock valuation model. This is called corporate value model, right? Rather than dividends, this model concentrates on firm's free cash flow. Okay. By the way, if you have any questions anytime, please either write here or ask. Okay. Then what's the free cash flow? Free cash flow is the net operating profit after tax minus net capital investment. Okay. In this course, I'm not going deep about this free cash flow. In our questions, it will be given, this free cash flow will be given. So probably you cover these concepts in your accounting classes. So I'm not go over it once again, right? So NOPAT, what's NOPAT? NOPAT is the net operating profit after tax, right? Net operating profit after tax. Okay. For this model, we need to estimate the future free cash flow of the company, right? So the future, if you can estimate the future free cash flow of any company, so you can count it and find the present value. Basically, we assume that firm's present value, the whole value of the firm, I'm not talking about the stock only, the whole present value, the equity value, is the present value of this cash flow, right? Basically, let me show you. I'm sorry, guys. Can you see this? Can you see it? Yes, okay, good. Yes, basically the market value of this firm, the equity value, is the free cash flow of first year divided by 1 plus not the expected return, not the market return, but weighted average cost of capital. We will talk about it. Plus second year free cash flow, right? Divided by 1 plus weighted average cost of capital square until forever, right? So we have the same concept, same methodology, like the dividend discount model. Let me go back to our slides again. Okay. So we can find the equity value of, or the market value of this firm, not the equity, but the market value of this firm by discounting all the free cash flow. The free cash flow, the value of the firm is the discounted free cash flow. We discount all this free cash flow by weighted average cost of capital. right? So assume that your company, you have the assets of your company, like let's say 5 million ASEAN, okay? And all the assets in your company is the 5 million. And plus, you have to, let's say you have a liabilities, you have a loan, you took a loan from a bank for, let's say, 2 million. Then what's the value of your equity in this case? 5 million is all your assets, minus 2 million is your debt, and your equity value, market value of your equity, the left, is 3 million, right? So if you divide this 3 million, this, if you divide this 3 million by the number of shares, let's say 10, you have the 10 outstanding shares trading. Yes, you cannot see me. I'm not. I'm just showing the slides, not myself. So you can find the price of any stocks. Okay. Um, right. Once again, one way to find the value of price of any stocks. Can you hear me once again? Is it clear? Yes. Good. Good. Thank you very much. Uh, let's start with our 5 million example. Assume that you have a stocks and you have a company, all in your company, all your assets is 5 million. Plus you have debt or loan of 2 million. Then your value of your equity is 3 million. What's left, right? If you divide this 3 million by the number of shares outstanding, let's say 10, then you can find the price of one share. So this is the one way of calculating price of one share. Okay. Uh, how do we, well, you remember we talk about the weighted average cost of capital. So how do we calculate the weighted average cost of capital? As you all know, any business, market value of common stock simply equals to asset minus liabilities, right? Sander, you are right. Exactly. Um, weighted average cost of capital. You know that all the business can be financed either equity, like our example, 3 million equity, or debt, like our example, 2 million debt, right? It can be either equity financing or can be borrow money and call debt financing, or both. You can finance your company, in our case, 5 million, in both ways, 3 million equity, 2 million debt, right? In this case, you need to find the average cost of capital, right? So how do you calculate the average? Of course, you have to know the uh, market value, I mean, the percentage of your equity, right? How do you calculate it? Basically, here is the calculation. Market value of equity divided by the total market value of equity. In our example, 3 divided by 5, right? Both equity and debt. So you can find the percentage of your equity in your portfolio, in your cost, in other words, plus market value of debt divided by the total market value of equity and debt. In our example, 2 divided by 5, 40% of your financing comes from the debt, and we have 1 minus tax rates. So why do we need 1 minus tax rates? Because tax is, well, if you borrow loan then you have to pay interest, right? This interest, this payment, this cost is tax deductible. As a company, you have to pay corporate tax. And this interest payments is deducted from your corporate tax, right? So it gives a kind of tax shield. So if your interest payment is high, then means that your tax shield should be high. So to calculate the net effects, you need to add this 1 minus tax rate to your debt part, right? Is it clear? Any question related with this tax shield? I'm waiting for your response. Uh, I guess there isn't any question. Good. Okay, let's move on. Right? Because why do we multiply tax rate only by debt but not equity? Because for your debt, you are paying an interest, and this interest is your cost, right? You are paying interest to the bank, right? And this payment is your cost for your company. And this cost is tax deductible. Instead of paying to the government as a corporate tax, you are paying to the bank and you are deducting from your tax payments, overall tax payments. So that's why we are not paying any cost to anyone else for our equity. It's our equity. It's our money, right? Right. Let's move on to the next slide. So basically, we are using the same model, same calculation as we did before, right? The market value of the company, let me show you. I hope you can see it. Oh, right. The value of the company, right, can be calculated by free cash flow. We assume that this free cash flow, like dividends, increasing with G growth rate, right? The first year, next year, free cash flow divided by weighted average cost of capital, instead of required return or expected return, we have weighted average cost of capital, the cost of all equity and debt minus growth rate, right? Basically, the terminal value here, anyway, I'll show you this part later on, right? So instead of price, now we are using the market value. We are using the same formula, right? Okay. Here is an example. Assume that our growth rate is 6%, means that our free cash flow will increase 6% after the 3 years, right? Weighted average cost of capital is 10%. So we will see how to calculate weighted average cost of capital, but right now assume that you have only 10% is given, okay? And it's given we have the 3 cash flow. The next year we have minus 5 million, let's say AZN, because assume that you are building a factory, so you need to pay this amount of money, right? Minus 5 million. 2 years from now, you are expecting to receive 10 million, right? 10 million as a free cash flow. And the third year, you are expecting to have 20 million. And starting from the year 4, this free cash flow will increase with the 6% constant growth rate, right? Then we can calculate the like P3, TV3, I mean terminal value 3. Here is the formula, right? Like this one. TV3 like P3 we did before is equal to next year free cash flow like dividend, next year dividend, divided by weighted average cost of capital. It's given as a 10% minus G, it's given as a 6%. So we can calculate the third year terminal value. But be careful, this is the third year terminal value. Then we need to discount third year terminal value to today, right? Exactly, instead of R, we are using weighted average cost of capital. We are discounting this third year value to today with the 10% weighted average cost of capital, right? Then when you add this value, when you add this all, the market value of this firm is 416.9. So we can calculate, we know that this market, the value of this firm is 416.9 ASEAN. Okay. So here R is like our interest rates, right? We discount with 10%, right? Weighted average cost of capital in this case. Okay, assume that the same firm has the 40 million in debt, right? And 10 million shares of stocks outstanding. What is the value per share? You know that the value of this firm, we already calculated in the previous slides, $416.9 million ASEAN minus the value of your cost for your debt. I'm sorry, like we did, like our example, 5 million example, 2 million is the debt. You remember, here is the 40 million debt. So the remaining part is 376.9 is your value of equity, right? Then if you divide your value of equity, the number of shares outstanding, here is the given as a 10 million, then we can calculate the PO, price of single stock. Any questions up to now? Of course, we can move to the previous slides. Yes, here is. Sander, any question? So in these slides, -5, the outflow, plus 10, the inflow. In this slide, we discount all of them, same as the fourth one. Yes, we discount -5 with the, basically, let me try to write here. We discount -5 by 1 plus, oops, I'm sorry, I need to correct it. Let me write once again, sorry. Minus 5 divided by 1 plus 10%, right? So this should be equal, because we are discounted with the 1 year, should be equal to minus 4.545. Okay. So for the next year, we are discounting 10 plus 10, of course, with the 1 plus 10% at this time square, because we have 2 years, right? This 2 is the square, should be equal to 8.2464, right? Well, basically, first few cash flow, we divide it manually. We do it, we discount it manually. And starting from the year 4, we discount it with this formula, because we know that starting from year 4, the growth rate is 6%, right? Here is the starting from the year 4, the growth rate is the 6%, and the weighted average cost of capital for this project is 10%. It's given, right? So we can calculate the year 3 terminal value, then we discount it to year 0. Is it clear? Basically it's same as the dividend growth model. We are using the same formula, basically. We are discounting in the same methods. Instead of P3, we have terminal value 3. You remember it was P3 in dividend discount model, but here we have terminal value 3, TV3. That's it. Then we discount this terminal value 3 to the today, right now. Okay, let's move on. Like PO3, but yes, but it's not the single stock value, but actually it is the market value of the firm. Now, right now, we are not talking about like P0, the price of a single stock, but we are talking about the whole value, the market value of a whole firm, both equity and debt. Okay. So 416.9 is the market value of the firm. Why do we need weighted average cost of capital? Here I'm going back to the previous slide. Why do we need weighted average cost of capital? To find the terminal value 3, because we know that starting from year 3, we have a constant growth rate with 6%, right? With the 10% weighted average cost of capital. Then, of course, we need to discount each cash flow, which is in this case 5, 10, and 20 manually, one by one, with the weighted average cost of capital again 10%. Weighted average cost of capital, right? Is it clear? Right. Then we know that 416.9 is the value of a firm, minus debt is given, right? The remaining part is the equity, the value of equity, market value of equity, right? If you divide this amount by number of shares outstanding, you can find the single stock's price. Okay. Right. Any questions up to now? So this is the second model. So I will send you more study questions about this part. So don't worry about it. So we have a few calculations as well at the end of this lecture. Okay. If you want to find P3 in this case, we should find MV3 and divide the number of shares. Yes, right, of course. I'm thinking about it. Yes, why not? Sounds logical. Okay. Another method is the multiplier, right? So analysts usually use this methods, this firm multipliers method, right? Uh, how it works? Usually, analysts try to estimate the market or the comparable firms' uh, price earning ratio or price to cash flow or price to sales ratio, and based on this uh, assume that you know that the, let's say, you are operating in an oil industry and you know the price earning ratio of the oil industry, the whole industry. As the target company is operating in the same industry, so you expect to have the somehow the same price earning ratio. Then if you know the earnings, based on this earnings, you can calculate the price, right? Assume that, let me show you. Assume that the price earning ratio is 16 for this industry, right? And you know that your earning is 1.13. Okay, for a share, single share. Then you can, based on this information, you can calculate the expected price, right? It is the case if the price earning ratio is 16 and the earnings itself is 1.13, then this price of the stocks should be 18.08, right? Uh, you can calculate it not based on the price earning, but based on the sales and based on the other ratios as well. Okay. Um, okay. Any questions? This is the easiest way. Okay, let's move on. Okay, what's the equilibrium? In equilibrium, of course, stock price should be stable. I mean, there is no tendency for people buying or selling the price, so you have somehow the constant stock price, right? So in equilibrium, we have two conditions should be held. The first one is the intrinsic value of this stock should be equal to the market value, right? The price, this price should be equal to the intrinsic value, price head, right? Okay. And the expected return must equal to the required return. So here is the expected return, right? how do we calculate the expected return? Your dividend return plus your growth rate, your expected return, right? Of course, the expected dividend return, because we don't know, this is the D1 is the calculated or expected dividend for next year, right? Plus the expected growth rate, or should be equal to required return. So how do we calculate required return? Basically, we can calculate the required return based on capital assets pricing model, right? Okay, then let's move on with these CAPM methods, right? Well, let me go back to the slides. What do we have in CAPM methods, capital assets pricing model, right? We have risk-free rate, which is the government treasury rates, plus market premium. The market premium is the difference between the market return minus risk-free rate times beta. Beta is the sensitivity of assets to the market return. Let's assume beta is 1, means that if market goes up 10%, this stock itself goes up 10% as the market. If, let's say, beta is 0.5 plus 0.5, means that if market goes up, the market index 10%, this stock only goes up 5% because the beta is 0.5, right? The beta can be minus as well, or can be more than 1, right? If it is minus, means that the market goes up, but the stock price goes down, or market goes down, but the stock price goes up, like a gold price. Right? So based on this information, we can calculate the required return with the CAPM formula. Yes, this is CAPM is this basically this formula. Okay. If expected return exceed required return, if it is not equilibrium, of course, then this stock is attractive, right? Then everyone try to buy it, and of course, the buy orders will be higher than sell orders, and the price goes up until the expected return should be equal to required return, and the price PO should be equal to expected intrinsic value, right? PO hat, right? Okay. Which factors affect the stock prices? Of course, based on this CAPM formula, risk-free rate. Beta, what does the market risk premium? The market risk premium means the market return minus risk-free rate can affect it. What else? Of course, the inflation rate can affect it, because inflation rate affects the risk-free rate, so that's why it affects everything. Growth rate of G, this growth rate affects our price, right? It might be the market conditions, or it might be related with the firm specific conditions. But anyway, it affects us, right? These are the factors that can affect our price. Okay. How can we see the market data, the stock data? Well, it's okay. Before starting this slide, what's market risk premium? Market risk premium basically, let me go back and show to you. Market risk premium is this part, RM minus RF, right? So market return, the index, think about the index return minus the risk-free rate return is your market risk premium. Is it clear, Nazrin? Okay, thank you. Let's move on. Yes, well, how can you find the stock value, stock data? You can find it anywhere else. Nurlan, let me finish this question, then let me finish these slides, then we'll talk about it. So in this slides, you'll see for the last 52 weeks, right? The maximum and the minimum price for this specific stock. What's the name of the stock? Gap company, right? The name of the stock. So here is the symbol, GPS. This company Gap pays a dividend of 9 cents per share is given here. So given the current price, the dividend yield is 0.5%, right? Here is the given dividend yield. Price earning ratio with the current price, of course, is 15. If you change the price, everything will change accordingly, right? It's here. Here is the closing price, the latest price, okay, 19.25. Today's maximum and minimum price is traded between this 20.5 and 19 and closed with 19.25. Like the 52 weeks, 1 year high and low prices, right? And today, 6.5 million shares are traded in this market, right? So these are the basic information about any stocks. So you can find this information online as well. Like here is another type. The company is the GlaxoSmithKline, right? The price is right now 45.79. Okay, previous price, and again here is the 1 year minimum and maximum prices for the last 52 weeks, right? Here is the average volume. Here is the price earning ratio, earning per share, dividend yield. So even you have the graph for the last, if I'm not mistaken, 1 day graph. It's starting from 10 a.m. to 4 p.m. Price earning ratio is if you know the earnings for your company, then it's the price divided by earnings. So with this price, how long does it take with the given earnings? How long does it take to cover it, right? So it's a ratio. If it is low, means that that company is cheap because with the high earnings, easily, I mean, remember our example, 16 price earning ratio is 16. So it means that in 16 years time, you can have your with the given earnings, if it is the same, assume that we'll have the same earnings for the next 16 years, you will have it, right? Here, the previous price is, yes, here is the last trade dates, right? Previous close is the last trade days close, right? Uh, Price earning ratio is with this given price level and this earning levels in 17 years time, uh, you can you will have, yeah, yes, you will be in break even. Let's say you will pay something else as a $45.79, right? And your yield is, your earning is 2.65, right? So it takes 17 years, if I'm not mistaken. Let me calculate it. 45.79 divided by 2.65. It takes 17 years, right? With this price and earning levels. Clear? Okay. So we have preferred stock as well. Preferred stock is like bonds as well. I mean, it has the same characteristics as both bonds and stocks. Well, actually, it doesn't have any voting rights, but uh, it pays the fixed dividends, right? Of course, forever. So it's a kind of perpetuity, right? Assume that uh, preferred stock with the annual dividends is $5 and the price is the $50, then the expected return, of course, is the 10%. So it means that this company pays you $5 forever as a dividend. Then the preferred stock value, of course, is different than the common stock value, is 50. So you can buy it like a perpetuity bond. You can pay 50 with 10% return and risk $5 forever. It will not increase. No, well, of course, preferred stock pays you the fixed dividend. And day one, you know it, it will pay you 10% forever, right? Like perpetuity. Okay. Uh, I'm sorry about this slides. I don't know why it's like this, but can you read it? I know it's difficult. I don't know what's wrong with the slides, but we have two slides, unfortunately, like this. Okay, let me. This company, XXX company, um, is has a new CFO, and this CFO wants to calculate the weighted average cost of capital, right? And we have the following information. We have the risk-free rate is 4.5%. Risk premium means RM minus RF is 5.7%. This corporate tax rate is 38%. And we have debt to equity ratio, but be careful, it's not debt ratio, it's not equity ratio, it's debt ratio divided by equity ratio, right? 0.7%. Okay. Uh, Cost of debt, of course, this company is much riskier than the government, and of course, therefore, the cost should be higher than the uh, risk-free rate, government treasuries, government securities, right? And this spread, this differences is 2.25%, it's given. And the beta of the company is 0.86, means that if the index itself goes 10%, this company, the price of this company goes 8.6%. Of course, in both direction. If it is minus, it goes down less, right? So given this information, we need to calculate the weighted average cost of capital. Okay. Here is the weighted average cost of capital formula. We know that we need to find the percentage weight of equity and percentage weight of debt, right? Oh, let me show you. Okay, can you see it? Okay. As you have seen, we can finance our company with both debt and equity, right? So debt plus equity should be equal to 100%, or in other words, 1, right? This ratio, debt to equity ratio, is given as 0.7. Then we know that debt plus equity should be equal to 1. If it is the case, debt should be equal to 1 minus equity, isn't it? Then we can put, here, instead of debt, we can write 1 minus equity divided by equity is equal to 0.7. So if it is the case, could you please calculate the equity and debt weight? I'm waiting for you to calculate it. Slightly different, if I'm not mistaken. Yes, no. Let me check it. Yes, you're right. Here is the result, as you said. So 58.82 is the equity, and the remaining is the debt, of course, right? So we know the equity part, weight of equity. We know the weight of debt, right? Then we need to calculate the cost of equity and cost of debt. Okay. So how do we calculate the cost of equity? Using CAPM. Let me show you here. We know that risk-free rate is given as okay, I can show it to you. How do you find, right? Let me show it to you again. Right. Can you see, Algon? Right. As you have seen, equity plus debt is equal to 1. Then if it is the case, we can calculate it, right? Okay. Yes, cost of equity and cost of debt, right? Well, here is the W is the weight, and RE is the cost of equity and cost of debt. Let's go back to this calculation. So we know that risk-free rate is 4.5%, right? The market premium is given as 5.7% times beta, right? It's given as 0.86. Then altogether is the cost of equity is 9.4%. We know that this company is riskier than the government, and the differences is 2.25%. So altogether is the cost of debt is 6.75%. When you plug the numbers, the equity, the weight of equity, the cost of equity plus weight of debt times cost of debt plus, of course, we have the tax shield. 1 minus tax rate is our tax shield. So the weighted average cost of capital in this case is 7.25%. Okay. Any questions? How do we calculate this weighted average cost of capital? All clear? There's a question. Yes, Nurlan. Of course, the company itself is riskier than the government. So that's why. So we don't need any other information. If you have a company and versus government, of course, the company is much riskier. And next slide or previous slide? Nezrin, are you asking for the previous slide? This one? The calculations. Yes, here. Debt to equity ratio is given as 0.7, right? Then based on, we know that debt plus equity is equal to 1. Then we can calculate the weight of debt and weight of equity, right? So we know it. Then we need to calculate the cost of equity and cost of debt. Cost of equity based on the CAPM formula, 2.25, I'll come to this point. So based on this CAPM formula, 4.5% is risk-free rate given. 5.7 is the market return is given. The beta is given. Then we can calculate the 9.4% as a cost of equity. And cost of debt is the risk-free rate for any company. Risk-free rate plus 2.25%. The 2.25% is given in the question here. Right. Here is the 2.25 is given, right? It's this company's cost is 2.25 more than the government's risk-free rate. The differences, the spread, right? So that's why we can calculate the 6.75%, the cost of debt for that company higher than risk-free. Then we plug the numbers to our weighted average cost of capital formula. Any problem, guys? Is it clear? What is weighted average cost of capital? As you know, Algun, you can finance your company either equity or debt or both together, right? If you are using both, then your cost is the weighted average. The cost of equity times weight, of course, plus the cost of debt. If it's 50-50%, then basically you need to add both of them and divide by 2. If it is 60-40%, then you need to calculate it accordingly. Cost of, for any company, free, of course, the cost of company is higher than the cost of government, right? Which is risk-free, RF. So the company should pay premium, risk premium, because the company is much riskier than the government. Is it clear, Nurlan? Always, yes, always the government is much safer. The company is much riskier. Risk-free rate is always the government rate, right? We know that the government is never defaulted, but company do. So this differences is the risk we have to pay or receive. I mean, depends on where you are. Okay, if all clear, I'm moving to the next slide. Sorry again, I don't know why. I mean, anyway. So here is the an analyst wants to calculate the company's weighted average cost of capital using the dividend discount model. But this time, okay, we're starting before this question, there's before this example, there's a question. If we finance our company with equity and debt, so we should find the cost 7.25 is your average, right? Go back to previous slide. Weighted average cost of capital. Yes, 7.25 is your weighted average cost of capital on average, including the tax shield, of course. 1 minus 0.38 tax rate. This tax giving tax expenses gives you an advantage, right? How you plug these numbers? Where do you use this weighted average cost of capital? Let me show you. Where do you use this weighted average cost of capital? Here, can you see it? So for calculating the company value, free cash flow, next year free cash flow, divided by weighted average cost of capital minus G, like the dividend growth model. Same formula, same concept, same calculation with different. Okay, got it. Thank you very much. Okay, let's move to the next question. Any questions, guys? Okay, let's move to the next one. Okay, this time our analyst wants to calculate the weighted average cost of capital, but using dividend discount model, right? We have the following data. Cost of debt is 8%, so including the spread, everything is given here as an 8%. So the whole together, the risk-free rate plus the company specific spread is 8%. Corporate tax rate is the 40%, right? Debt to equity ratio is 0.8033. In this case, can you please calculate the debt and equity percentage? If debt to equity ratio is 0.8033, spend a few seconds to calculate it, please. Please calculate the weight of debt and weight of equity based on this information. Yes, Algun, you're right. Exactly. My suggestion, use 4-digit after the comma, right? Yes, but please try to use 4-digit after the comma. Right. Then we have the stock price as 30, right? We know the next year dividend as 1.5 and the growth rate is 7%. So these are all given. Okay. So with this given information, we can calculate the cost of equity, right? Because we know the D1 is given as 1.5%, $1.5, right? Uh, we know the growth rate is the 7%. We know that this is the price of this. Let me go back. The price of this stock is 30, right? So all we need to find the cost of equity. 30 should be equal to price of the stock is equal to dividend 1, next year dividend, divided by RE minus G, right? Expected return minus growth rate. So we can calculate as a 12%. As you said, cost of the weight of equity and weight of debt is the 0.55 and 0.44 almost percent. Then, based on this information, we can calculate the weighted average cost of capital. These two slides, hopefully, much better in your Blackboard's account. Please download it from the Blackboard account, right? Then you can calculate the 8.8% as weighted average cost of capital. Yes, we have 8 more minutes. Yes, the terminology is different, RS but RE. But here, you remember in the equilibrium, the expected return should be equal to